Hello and welcome to Bloomberg Quint Live, and you're watching Trend Spotting. I'm Navneet Saluja D'Souza.
Good morning, Navneet. I'm Agam Vakil. In the next 30 minutes, we deep dive into specific trends in the markets to draw key takeaways and implications for investors. First, the headlines. Markets erase early gains with both benchmark indices trading with marginal cuts. India VIX surges. And IndusInd Bank is one of the top nifty losers after RBI imposes a 3 crore penalty for breaching income classification norms. And the Supreme Court hikes iron ore mining cap in Karnataka from 30 to 35 million tons per annum. And second phase of polling kicks off in Gujarat with 93 of 182 constituencies going to polls.
Okay, let's take a look as to what the markets are doing right now. Well, they're trading at day's low, so the markets have given up their opening gains, and once again, they were unable to sustain the opening gains. If you look at Nifty right now, 10,160 is the mark. It's also broken its yesterday's low of about 10,170, so definitely you can expect a little bit of more selling pressure to come back because yesterday's low has been breached. Nifty is right now trading below its 20 as well as 50-day moving average, and a concern for this market has clearly been the high volatility. Despite of the gap up opening we see, but the India VIX has been trading on the higher side, so currently inching very closer to that crucial mark of 17, and that's at elevated levels, 5% higher for India Volatility Index, ahead of that crucial outcome of Gujarat elections, which will be announced on Monday. But remember, in the evening, you will get the exit poll, and precisely that's the reason there is some bit of nervousness which is being seen in the markets. Let's also do a check for the broader markets. They too have given up their opening gains. So the mid-cap as well as small-cap index are trading with cuts right now, and the Bank Nifty, that's going to be in focus as the weekly options contract, they expired today, and the range that one is looking at is between 24,700 to about 25,300. I know the range is pretty wide, but there is more volatility which is seen for Bank Nifty as well. So right now 24,950 is the mark, and it's trading below its 50-day moving average. Quickly, I just want to pull up the contributors list and see which are the stocks which are dragging Nifty lower right now. So these are your heavyweights: TCS, HDFC, SPI, which have contributed the most, but I guess it is looking like a broad-based selling pressure because your top loser is TCS, which is contributing almost 9, and the somewhat gains are being supported by HCL Tech, Infosys. So IT counters, HCL Infy are doing pretty much well alongside M&M and Dr. Reddy's Laboratory. But what about the broader markets, Agam?
Well, not very encouraging, Navneet, because we're looking at about one gainer for 4 losers when it comes to the Nifty 500 index. So we certainly are looking at a lot of declines in terms of the number of stocks that are moving down. So let me start off with some of the losers. We are looking at weakness in Videocon Industries, which is down 4.8%. We have weakness in AU Small Finance, which is also down 4.6%. Aegis Logistics, Motilal Oswal Financial, Gen Irrigation and Hathway Cables all losing out between 3.5% to 4% in today's day of trade. In gainers, however, there is substantial amount of momentum now building up for Manpasand Beverages, where, if I'm not mistaken, we've seen an increase in the FII holding limits, which is why it's moved up by as much as 8% for now. DCM Shriram, of course, reacting to earnings are up 6.5%. And Relegate Enterprises, of course, also has a lot of developments going on, but for now it's up 5%. Natco Pharma, Oberoi Realty, of course, on the back of an initiation by one of the brokerages, which is very positive on Oberoi Realty, which is why that's also gaining 3.5%, followed by Wockhardt. So on the whole, while we have some momentum in gainers, the advanced decline ratio certainly doesn't look good when it comes to the Nifty 500.
That's right, Agam, and as we speak, you can see fresh lows for the day for Nifty. It's off almost 75 to 80 points from its opening highs. All right, then, on Trend Spotting today, we put the focus on the impact of Supreme Court hiking iron ore mining cap in Karnataka from 30 to 35 million tons per annum as we connect with RK Goyal of Kalyani Steel. We discuss the growth trends in the shrimp industry and what is making investors go gung-ho on it as we connect with Ramakanth Akula of Waterbase. What is making Bhansali Engineering register strong gains this year? We asked Deepak Jasani of HDFC Securities. And finally, we also discussed the road ahead for Century Ply as we connect with the whole-time director and executive director of the company, Mr. Keshav Bajanka. Okay, then on to our first trend of the day. Select steel stocks are buzzing in trade. In fact, after the Supreme Court increased the cap on iron ore mining in Karnataka to 35 metric tons from 30 metric tons per annum. To discuss the impact of the same, we've got Mr. R.K. Goyal of Kalyani Steel, who is joining us on the show right now, and our colleague Nikki Merchandani, is also joining us. Mr. Goyal, good morning to you, and thanks a lot for joining us today on this big development which has taken place today. Could you tell us what's your initial reaction to it, which I'm looking at it, it'll be positive for a player like you who's looking at some bit of expansion plan, but I also want some clarification. Is the cap on individual mines going to continue?
Good morning. First of all, it's a very good judgment by Supreme Court. It was a long pending request to enhance this limit to 40 million ton. Nevertheless, 35 million metric ton is a good news. Now, actual iron ore production will increase once each individual mine, their production caps are enhanced. So we have to wait and see that how much time it takes for enhancing the caps. Once it is done, I'm sure we will get 35 million ton.
All right, so hi, this is Nikki here. The next question that I have for you is I want to understand if the C category is outside this limit of 35 metric million ton that we're looking at right now. If you could provide some clarification.
You see, these caps were on A and B category of mines. Now some of the C category mines are auctioned, and when the production will come from those mines, we have yet to see whether that will be part of this cap or it will be separate.
All right. Also, how fast do you see these mines getting the environmental clearance for upping this limit, which in turn could, translate into the lower iron ore prices, if at all?
Number one, it's very difficult to comment on the time frame during which this limits the cap is enhanced. As far as the pricing part is concerned, it is all driven by a base price from NMDC. Once it is up to NMDC whether they can reduce the price further, then only the price will come down. Otherwise, like even in this month, prices have been increased and we have to pay higher prices. And we are paying in Karnataka much higher prices as compared to Orissa and Chhattisgarh.
Sure. That brings me to this question of NMDC charging a premium for its iron ore products given the tight supply situation that we're looking at. Do you think after the sharp hike that NMDC has seen in this month, there could potentially be a price cut coming in from the company?
It's very difficult to comment on NMDC's internal strategic decisions related to pricing.
All right. With this, do you expect any kind of cost efficiency coming in for the company, given that we are seeing some kind of pressure coming in for iron ore prices, which have been, trading at a premium right now or being supplied at a premium? With that, do you see, since it's a key raw material to your production, do you think there will be cost efficiency that we can look in the forthcoming quarter?
You see, we are always focusing on the efficiency in terms of consumption, in terms of cost, irrespective of the price of iron ore. Our strategy, our behavior, attitude doesn't change whether the iron ore is 2,000 rupees or 4,000 rupees. Yes, psychologically, when the prices are very high, you tend to focus more. But we were focusing when even it was 2,000 rupees.
All right, sir. Thank you so much for your time. We'll leave it at that.
All right, thanks, Nikki. And thank you, sir, for joining us and giving us this perspective. Thanks, Nikki, for also taking us through that development. But we'll move on and, perhaps something which has been very popular these days, that is the shrimp business. Now, be it your choice in food or not, investors in the shrimp markets are definitely liking players in this space. With returns of over 200% so far in the current year, Waterbase is in ongoing upswing. But how have the growth trends shaped up for the industry and what is the road ahead? Well, for that, we are in conversation with the management, that is the Chief Executive Officer, Ramakanth Akula. Good morning, Mr. Akula, and thanks for joining us. Well, my first question will have to do with your capacity and its utilization. From what I understand, your capacity currently stands at around 1.1 lakh metric ton. Where is your capacity utilization then?
Our utilization is in between 45 45 to 50% as of now, and we are planning to increase this as we go forward. In the recent news, you would have heard about the amalgamation of Pinefeeds with us. So this gives us a combined capacity of 110,000 metric tons now.
Mr. Akula, I'm just going to take that question forward. You said 45 to 50%. So what sort of capacity utilizations that you're looking to achieve in the second half of this fiscal and also in FY19?
We are looking at taking this up to 60%, 60 to 65% next year.
Okay, and as your utilization levels are low, I can fairly assume that you do not have any expansion plans on the shrimp feed side. Am I right?
No, if you look at these capacities in the feed industry, mostly when we say capacities, this is the mission capacity. What we need to understand is this industry is a true seasonal, because almost 45 to 50% of your shrimp is produced in the months March to June. And then between July to November, only about 30-35% of the shrimp is produced. So most of the plant capacities, will be unutilized during the winter seasons. So if you look at the total effective capacity utilization, when you compare this with the mission capacity, if you are hitting about 80 to 85%, then that's the peak. So we have a mission capacity of 110,000, but the effective capacity that you can put to use, considering the seasonality in the business and the different sizes of the shrimp feed that you have to produce during the various stages of the shrimp life cycle, 80 to 85% capacity utilization means you will hit the peak. So for us, 110,000 ton is the mission capacity, so hitting about 85-90% of that, then that's the time for you to look at having new capacities. So we are talking about 85 to 90,000 tons. Once we reach that, then probably by that time we should have additional capacities coming in.
What about the raw material? What's the major raw material that is used to make shrimp feed, and how have been the trend with regard to prices there?
For shrimp feed, the main raw materials are soya, fish meal and wheat flour. These three products contribute almost like 70 to 75% of your total RM cost. And if you look at the RM price trend for the last 3 quarters, fish meal prices and soya prices have softened a lot. That's why you see a lot of margin expansion that has happened in the bottom line. Now we see a slow uptick in the raw material prices. Fish meal has started moving up, which was hovering around 70 rupees. Now it has crossed 90 rupees. Soya might also start moving up. So we may not sustain these margins going forward. These margins that you have witnessed in the last 2-3 quarters are quite abnormal. So going forward, I think we can expect that the margins could stabilize. The EBITDA margins could be around 13 to 14%.
So 13 to 14% EBITDA margins, but does the company pass the hike in raw material prices to dealers, or does it take the burden on?
If you take, say, last few years record, right from 2009 in the post-Vanama era, when demand exceeded supply, manufacturers comfortably passed on the increase in raw material prices onto the customers. But now the industry has overcapacity. We have almost close to about 2.8 million ton capacity in the industry. So in this changed scenario, we need to see whether manufacturers will continue to pass on the any increase in raw material prices onto the consumers.
Mr. Akula, what has been the impact of GST on your business? Because I believe shrimp feed is expected from this tax.
Yes, shrimp feed always was exempt from any taxes. So the output is GST neutral, but there are some products which have been brought, some of the input raw materials have been brought under the ambit of GST, so that has some marginal impact on the input costs. Otherwise, shrimp feed as such is exempt from any tax.
And in terms of outlook, do you expect an uptick in realizations, Mr. Akula?
I don't foresee that in the immediate future because right now the raw material prices are, though there is an uptick, as I said, still there is enough margin available to us. And considering the new equation that is getting set in the marketplace with number of players coming into the shrimp feed business, we need to see whether manufacturers can take the risk of increasing prices when it is not warranted.
And on hatchery side, what's the capacity that you're building? What is the total capital expenditure that you've incurred so far, and by when will that start?
We are building our first state-of-the-art Vanamai hatchery in India because we feel that shrimp seed quality is of paramount importance for sustaining the growth in this aquaculture business. So we are setting up our first Vanamai shrimp hatchery, and this is being set up with a capex of over 20 crores. And it will be done in two phases. The first phase will be of 250 million capacity, and the second phase will also be of 250 million capacity. So the first phase construction is getting over, and we are now getting into getting the clearances and the licenses from the government, and post that the trials will commence, and we are looking at realizing the benefit at the sales and everything in the next fiscal year. So we will start commercial sales probably by March or in the first quarter of next year.
So how much does processed shrimp contribute to your overall revenues, and what kind of growth are you expecting from this particular segment?
I mean, in this year, we have exported only about 10 to 11 containers, and as I told you, we are not fully focused on that business. We do third parties to utilize this capacity, so there are merchant exporters who use our facility. We are not fully into the processing and export business because currently our focus is on feed and how to grow the feed business, how to fill the capacities. So, and then the focus is also into commissioning hatcheries because we feel that seed quality is of paramount importance, as I mentioned. Processing and export business, we don't have to invest anything. We have the infrastructure right in place. The only thing is we are just building some competencies, and once we have the management bandwidth, we will get full throttle into the processing and export business. But as of now, processing and export business doesn't contribute significantly to us. Almost 96-97% of our revenues come from our feed business.
So shrimp feed is your main business. So what's the kind of growth that you're expecting from there?
I mean, the industry is growing at 12 to 15% every year. So we are very confident that we can achieve a higher growth than the industry growth rate. We are targeting a growth rate of at least 20% going forward.
Mr. Akula, thank you for joining us and giving us your outlook on Waterbase and perhaps also the industry. But we'll move on and we'll talk about Bhansali Engineering Polymers because that stock has seen gains of as much as 650% so far in the current year. What has been aiding this up move in the counter? Let's get an analyst view on this. Joining us on the phone line is Deepak Jasani, Head of Retail Research at HDFC Securities. Deepak, thanks for joining us. Good morning. When it comes to Bhansali Engineering Polymers, as I mentioned, we've seen a surge, the stock's going from strength to strength. If you can elaborate as to what is actually driving the stock upwards and whether or not there is still space for the stock to move upwards in, say, the next 1 year.
Good morning. Basically, we came out with a pick on Bhansali Engineering on August 7th, 2017, when its price was 74, and our targets were 85 and 96. Why we were excited about the stock was basically the company is into manufacture of ABS resins, which is used in manufacture of home appliances and automobiles in India. The company had increased its capacity from 51,000 tons to 80,000 tons during FY17 and is now reaping the benefits of the increased capacity. It has plans to increase it further to 137,000 tons and later also increase its capacity by way of a new plant, which is a slightly long-term thing. Now, the promoters have been acquiring shares from the open market, creeping acquisition between Q4 FY14 to Q1 FY17. So that also gave us some confidence. The margins also were seeing an up, basically 7.5% in Q1 of FY16, went up to 11% in Q1 of FY17, and also further went up to 13.2% in Q1 of FY18. All this led us to believe that the company is on a growth path. Now that ultimately has proved to be right in a sense that the HY sales have come in much higher than expected. The margins are also for the half year at 14.3%, and our FY19 estimates they would now achieve in FY18. That is what we feel. Of course, the share price also run up so far, even much beyond our target price.
Deepak, what was your target price on Bhansali?
96 was our target price.
96, okay, and the stock's almost doubled from there, I would call it. But so what would you recommend investors who had bought this? Is it the time to book profits here? Because the valuations do appear at elevated levels.
Yeah, so now on a rough cut calculation, FY19 May, it would do about 6.9 rupees earning. Quoting at 168, it is quoting at 24.3 times. The whole chemical space in the market has undergone a re-rating, but at 24.3 times FY19, probably there may be a little upside, but for a better margin of safety, I think investors can wait a little more on the downside.
Okay, Deepak, from what I understand is that the company looks to supply to marquee automotive and appliances clients, and they're also looking to, increase their capacities through brownfield expansion. Do you think that this can lead to near-term pressures when it comes to increased costs?
Basically, there are just two players in the industry, I think Bhansali and Ineos. And the industry is seeing a 15% growth in demand year on year. So unless both the players go aggressive on undercutting prices, I don't think that margins can fall sharply from here.
Okay, and I'm just looking at the first half of the earnings. They've done almost close to 34 crore of profit, which was the total profit seen in financial year FY17. What sort of growth you're expecting in the second half? Do you think they can maintain the same run rate?
I would think so. On a rough cut basis, even doubling of the first half PAT would lead to an EPS of about 5 odd rupees in the full year. And in the next year, probably they would do another 35-40% growth in the bottom line.
Deepak, you also mentioned that the promoters have been showing confidence into this business, and as I can see, financials are looking pretty good. They've been increasing stake, as you said, in the last few financial years. I'm just comparing 2 quarters here. June to September versus June, the promoter stake has actually come down by almost 2%, and over 55% of the promoter shareholding is pledged. Is that does that send out any message to the investors with regard to they should be a little bit cautious now?
Yeah, as I said earlier, that the current price has run up quite a bit. So at current levels, investors should wait for a little more correction. The overall market is also a little overbought, and the mid-cap space also could see a little bit of correction.
Okay, Deepak, we'll leave it at that. Thanks for joining us and giving us your view on Bhansali Engineering Polymers. We'll be keeping an eye on that stock and how it does, of course, further developments as well. But we'll move on and address Century Ply, which has also seen healthy returns of over 90% in the current year. And Edelweiss has come out with a report that states that the GST rates, shift to organized players, and government's focus on housing will boost growth for the company and other players in the housing ancillary space. So to discuss the outlook for Century Ply in further detail, we have with us whole-time director Keshav Bhajanka. Hi Keshav, thanks for joining us this morning. Let me start off with your current capacity in plywood segment and how much more, does the new MDF plant add when it comes to your capacities?
You see, currently our capacity is about 240,000 cubic meters when it comes to plywood. However, our rated capacity is always based on 6 days working. So we can actually increase capacity by about 15% just by extending it to a 7-day working cycle. Currently, we're at about 80% capacity utilization, and I think this is going to ramp up very quickly going forward. MDF adds about 2 lakh cubic meters, but the product is lower priced than plywood. Hence, in terms of turnover, MDF would add about 30 to 35% to our current plywood turnover.
Keshav, how much will the new MDF plan add to your overall top line in the current financial year, and by when do you see it reach the optimum utilization levels?
I believe that this year we would close the year at close to 70% capacity utilization. So we can look at a turnover of close to 140 to 150 crores for the current financial year. And going forward next year, I think we'll ramp up quite quickly. I think we're looking at 90% plus capacity utilization, which is a turnover of 350 crores plus next year.
And apart from Myanmar and Laos, which are the other countries from where you import timber? And do you expect raw material prices to go up? If yes, then what will the impact be on your margins?
You see, normally what we do is we have manufacturing units in Laos and in Myanmar because these countries are banned the export of timber. So we peel logs there and we export the face veneer to India. There are other countries such as the Solomon Islands or Papua New Guinea from where we import logs, from where the export of logs is still allowed. So we import logs from these countries, we peel it in India, and then we use the face veneer produced for our own consumption. These prices are highly variable. It depends on the market conditions. It depends on a lot of factors. But whenever there's a price increase, we normally pass it on to the market. So if there is a price increase in the raw material cost, it never impacts our margins much. It may impact our margins for about a quarter, but after that, our margins stabilize again because we pass on the raw material price increase to the end customer.
Right. Keshav, stay on with us as we just address those important flashes. We've got the November WPI inflation numbers which have just come out at 3.93% versus Bloomberg estimate of almost 4%. So just slightly below that estimate, but it was largely expected that the number would be higher sequentially. So the November WPI inflation 3.93 versus October of 3.59, as the CPI number which came out this week was on the higher side. So it was largely priced in that November WPI will be higher than what the number was seen in the month of October. Okay, then back to our discussion with Keshav. I think the company is also looking to increase its laminate capacity to about 7.2 CMB versus the current one of 4.8 million CMB. Could you tell us what's fueling demand in this segment?
You see, in laminates, we were a smaller player for about the first 7-8 years of our operation. We began our laminate operations in 2004, and for the past few years, we've been able to increase our market share. We've been growing at about 25% per annum. I think this has been fueled by good progress made in the market in terms of gaining market share of competition. And going forward, we are very bullish on this sector. And due to the same, we have increased our capacity. And I believe that within the next 2 financial years, we'll be able to absorb this expanded capacity as well.
And finally, with GST narrowing the gap in pricing between branded and unbranded products, have you managed to capture any market share?
You see, it's too soon to say because when GST initially got rolled out, the e-waiver was deferred. And for the plywood segment, GST was put at 28%. So actually, there was no impact because the unorganized were continuing in the same way that they were earlier. In fact, it became a bit easier for them to transact as compared to, say, prior to GST. However, on the 10th of November, the government reduced the GST on plywood from 28 to 18%. And this became effective from the 15th of November. And we've seen good traction in the market post that. So I think there is going to be a shift from the unorganized to the organized sector. And we are already seeing the signs of that happening. But in terms of volumes, I think it will take another quarter or two for it to pan out.
Okay, Keshav, we'll leave it at that. No, thanks a lot for joining us today and taking us through the developments at Century. But with that, it's a wrap on this edition of Trend Spotting. Thanks a lot for watching the show. Don't go anywhere. Coming up next is Hot Money with Darshan Mehta.